A hard money loan is a private, asset-based loan that caters to real estate investors. Hard money loans are different from standard mortgages because they offer short-term, high-interest financing and typically disperse funds significantly quicker than traditional financing options. The speed and ease of acquiring a hard money loan are what make them so attractive to investors. Rather than spending weeks or months trying to get a mortgage from a bank and then paying off that mortgage for 30 years, investors can apply for a hard money loan with minimal documentation and get the cash they need to invest almost immediately. The average closing time for hard money loans is between 2 and 3 weeks. For fix and flip investors especially, hard money loans can be the only option. If they apply for a standard mortgage, another investor will probably snatch up the property long before the loan gets approved and the investor has the capital to invest. Hard money loans are asset-based, which means that the size of the loan is based on the value of the property. This is because the asset is used as collateral for the loan, so if a borrower defaults, the lender will have ownership of that asset. The more valuable your asset is, the more cash hard money lenders will be willing to lend. Since hard money lenders typically work with investors, they place less emphasis on credit score, debt-to-income ratio, and other markers of personal financial stability. What hard money lenders care the most about is the profitability and riskiness of the deal. They collect information from borrowers regarding the property's value, its projected value after repairs or construction, and the cost of renovations. Because hard money lenders don't need as much information or financial verification as banks do, they're able to process deals and disperse funds for purchase far more rapidly. They're also more flexible than banks in terms of extensions and loan modifications because they're less regulated than traditional financial institutions. Since hard money lenders often underwrite deals with their own money, they have more discretion in how they disperse funds and are able to quickly alter the loan terms if the underwriters deem it necessary. Typically, hard money lenders will offer interest rates between 9 and 12% and will charge 2 to 4 points. This means that investors will be required to pay a fee of 2 to 4% of the total loan amount at closing, in addition to other fees like legal and processing. New investors tend to get the higher end of these rates, while experienced investors will earn the lowest rates, especially if they consistently work with the same hard money lender. Additionally, projects that have lower loan to after repair value ratios are more likely to be profitable and less risky for the lender, therefore eligible for lower rates. The term for a hard money loan is usually 12 months, but can be as long as 5 years. In the most common loan structure, borrowers pay monthly interest as well as a balloon payment for the principal at the end of the loan term. There are two main exit strategies for a hard money loan, sale or refinance, meaning that the borrower will either sell the property or transition to a long-term, low-interest loan upon project completion. Refinancing is common for investors who want to renovate a property with the intention of renting it out and holding it later. The key takeaways from this lesson are that hard money is a short-term, quick-close financing option for real estate investors, and that hard money loans are asset-based using the underlying property as collateral in the event of default. Hard money loans typically have interest rates from 9 to 12% with 2 to 4 points at close. In the next video, you'll learn about the three main hard money loan types: fix and flip, new construction, and cash out refinance, as well as additional variations like purchase only or rehab only loans.